Hello, my name is Paul Spence, and I'm with the Kalot Tutoring Lab. I'm going to do a quick video to review Chapter 1 with y'all, kind of break it down into simplistic forms and go over the basic concepts that you really need to get a hold of and understand. All right, so the first one we're going to start with is the accounting equation, which is assets equal liabilities plus equity. This is the foundation of accounting. Everything you do from here all the way up to the 600 level graduate courses will involve this. So it is important that you learn this part. As you can see, each one has its own T accounts. Debits are always on the left, credits on the right, no matter which one it is. But in assets, if it's a positive to that asset, it goes into the debit section. That'll be the hardest thing to get used to if you've never done this before. Whereas with liabilities and equity, if it's a positive, it goes into the credit section. It's double entry accounting. It's to make it balance out. If you have an increase in assets, then you're going to have an increase in liabilities, opposite side of the T accounts. And you'll see why we do that later on when we get into trial balances in Chapter 2. Besides that, some of the more important things to know are the concepts. Accounting assumptions. There are 4 basic assumptions accounting goes by. Going concern, which basically means that if we start to account for something, we will assume that we will be accounting for that forever. That it'll never end, that it'll continue to go forever and ever and ever and ever. The second one is the monetary unit. Regardless of how it's stored, kept up with in other ways, for accounting, everything is recorded in a monetary value. So dollars, pounds, guineas, whatever it may be, everything's recorded as a monetary unit. That's how we track the amount of it, is in that form. Next is the time unit. This is very important as well. This basically says that we record things in periods. We break everything down into small chunks of time, most commonly in years and quarters, which are pieces of the years, and we record everything that happens within that time for that period. And then finally, the business entity, which basically means that when we're recording for a business, accounting for business, we treat that business as its own entity, and all the recording we do is only for it. So when we record an asset, that asset belongs to the business. Same thing for liabilities and equities. We don't mix owners with the business and all that kind of stuff. Next, we have 4 accounting principles. Cost measure, or historical cost as it's more commonly referred to, basically says that when we record something, we record it at the cost we paid for it at that time, and it stays recorded that amount. We may buy something for $10, and then 5 years later it's worth 20. We don't change that 10 to 20. It stays at 10. That's the way it is. So that's that principle. Next is revenue recognition. This goes along with the time unit assumption in that revenue is recognized in the period that it is earned. Not when we are paid, but when we've earned that money. The same thing for the expense recognition. We recognize that expense in the period that we've done what is necessary or created that action that means we owe that money and we need to pay it. Whether we pay it then or not, if it's owed, we go ahead and record it in that period at that time. And then full disclosure is basically what it sounds like. We're required to disclose to the public all the information related to our accounting, transactions, what we've done, so that they can make decisions about whether or not they want to invest in that company. It's to keep the public informed. It's also important for internal managers as well, so they can make good decisions. There are some constraints within accounting, the accounting constraints. First one being materiality. Materiality is in reference to how important it is. So if we're looking at whether or not we need to make adjustments to an account because something doesn't look right, and it's a $2 billion account, and the adjustment we're looking at is $2,000, well, we say that was immaterial. It's not important. It's so minute, it doesn't matter. That's very important in auditing. Those of you looking into that, materiality. Next is cost benefit, or is it worth the cost to do what we're looking at? This is also very important as accountants. This is one that a lot of accountants lose track of as they're learning. It's always important to make sure you're weighing your costs against the benefits as you're looking at what you're doing. If I'm performing an audit and, you know, it's going to possibly bring in investors and show them that it's worth being invested in this company, and the investors might put in $1 million, but it's going to cost me $2 million to do this audit. Now, obviously regulations play into that. You have to do the audit. So, but there are other situations where you have to keep that in mind when thinking about decisions you're going to make. And then lastly, some legal acts that are important to focus on and think about. In 2002, SOX, or the Sarbanes-Oxley Act, was passed. This was the result of several I can't remember what the word is, but scandals that came out back then. Namely, Enron was a big one. HealthSouth was one that probably everyone's heard about here. It has to do with executives that were getting in trouble because their companies were going under for having bad accounting. They were claiming, well, I'm not an accountant, I didn't know. SOX fixed that. SOX requires that the upper level executives and the CFO of a company sign off on the audit every year saying, I have looked over this, I understand it, and it is true. So that was a very big one, had a lot of effects. And then the next one, which y'all are probably going to learn more about, is Dodd-Frank. There, you'll see it. Dodd-Frank was passed in 2010, so it's fairly new. They're actually still working out the details on this one, and it's a result of the 2008 recession, mainly due to the too big to fail issues. So it's designed to try and prevent that from ever happening again, keeping companies from being too big to fail. So, like I said, it's still learning, but that's chapter 1 in a nutshell. There are other things we'll cover in it regarding, income statement, balance sheet, but we're going to get into those in chapter 2 when we move on to it. So here it is. If you have any questions about any of this, or if you're wanting some more information or insight, you can contact the CLAT Tutor Lab at uab.edu. That's their email address. And anyone there will be happy to help you. Or if you want to Skype with them, just CLAT Tutor Lab. That's their Skype name, and they'll help you that way too. Thank you, and have a good day.